Hi there, my name's Matt. I'm an economics graduate and accountant currently living in the Northwest. Wishing a big hello to everyone out there, which at the moment is probably not likely to be all that many of you. Who'd have guessed that if you start a YouTube channel, post one video and then come back in 6 months' time, you probably haven't gone viral. Today I'd like to talk to you about transaction services and financial due diligence with a view to making the video that I wish I'd had the chance to see when I was umming and ahhing about what to do post-audit at Deloitte, and hopefully cover some of the important need-to-know topics ahead of a transaction services interview. Towards the end of my time at Deloitte, a lot of my friends and peers were expressing a vague interest in merger and acquisition, corporate finance-based careers, with the attraction being a more glamorous setting whereby high-profile deals complete late into the night with extravagant after parties and huge bonuses. It didn't take too much for me to jump on this bandwagon when I heard what life might be like. I'm obsessed with the TV program Suits, and whilst this is obviously based in a law firm rather than financial advisory, I was pretty much working on the basis that a career that might bring me one step closer to Mike Ross's life is certainly one worth pursuing. So just as a little aside for everyone, if you haven't yet seen Suits, pause this video right now, go and fire up Netflix, watch the pilot episode, and then come back and leave a comment down below thanking me for improving your life. You won't regret it. Anyway, to jump back to the world of M&A, CF, TS, FDD, and even private equity. All I knew at this stage was that I needed deal exposure, but was unsure exactly how to bring this to fruition. So to cut a long story short, some research was done, and I landed, rightly or wrongly, we can talk about that in a future video, on transaction services, primarily because it seemed like a more natural transition from my audit background. So what is transaction services? Well, as the name suggests, you're responsible for providing services in support of a transaction or a deal, whether that be an acquisition if you're helping a buyer, or a piece of vendor assistance work if you're helping a seller. In my experience, the core service offering is that of buy-side financial due diligence, which is pretty much all I've done in 18 months as a transaction services exec. I'd use the terms TS and FDD fairly synonymously. There is some nuance to that, but I think that's a safe assumption at this stage. And as a result, that's where I'll focus the attention of this video, on buy-side FDD. So what does carrying out FDD actually involve? And this can vary depending on the type of completion mechanism in place, whether that be lockbox or completion accounts. I'm not going to go into that in too much detail for the purposes of this video, although I definitely think you should be reading up on those two things ahead of any upcoming interviews. I'm going to focus on lockbox for the purposes of the examples I'll touch on right now. So what you're doing is effectively performing something approximate to an audit, albeit rather than being at the target business's year end, the work is performed at the lockbox date, which is a point in time agreed upon by the buyer and the seller, when effectively the risk and rewards of the ownership transfer to the buyer, despite the deal not being fully finalised. So just as an example, we may be acting on behalf of a private equity buyer who wishes to purchase a business with a December year end, and they contact us in mid-October. In this case, it makes sense to use the September month-end accounts as the locked box position, and if the deal completes in mid-November, a couple of weeks later, a profit ticker mechanism will be used to adjust for the impact of trading in the 8 weeks between the lockbox date of September and the middle of November. This profit ticker aspect of things is less relevant for the purposes of FDD. What we're really interested in is the 9 months of trading from the prior December year end through to September. And in order to assess this, we'll also review the two prior full year periods in order to give ourselves some comparative data to better understand upturns and downturns. So this forms the basis of our scope from a P&L perspective. We'll perform analysis covering all aspects of the business's P&L for the 33-month period, 2 years and 9 months to September. And what we do is use the target business's monthly trial balances to get 33 individual data sets, and then build this up to get annual trading results, whilst maintaining the ability to assess the business on a monthly basis if necessary. This is something particularly important for seasonality analysis. And then within the Excel workbooks where all this work takes place, we'll build up numerous tabs which analyse in specific detail every aspect of the P&L across the 4 periods in question, being the year to December 19, year to December 20, the 9 months to September 21, and importantly, the 12 months to September 21, which we can build up from our monthly data, taking the actual 9 months plus the last 3 months of the prior year. This is typically documented as a 9+3 approach and gives us what we'd call the LTM, the last 12 months trading. These key tabs in the workbook would include revenue split by stream or product type, revenue split by region or geography, revenue split by customer, cost of sales by cost type, staff cost by department, operating cost by cost type. So we're basically looking to analyse in as much detail as we can each of the sort of core lines within the business's P&L. And importantly, whilst we're making these relatively simplistic tables comparing the 4 years side by side, it's important to always be keeping an eye out for any significant year-on-year movements in individual balances, whether that be upturns or downturns. So just as a quick example, I'd certainly be making a note to myself to follow up with the management team to ask a question if travel expenses had tripled in the 9-month period to September 21, having been pretty consistent in 19 and 20. And the reason we're actually doing this analytical review of the data is to help identify any of these one-off or non-recurring revenues or cost which are included in the raw data but only distort the true or underlying level of profit the business is achieving. The business will typically be being purchased, at least in part, because the profits it's generating are attractive to the buyer. There are some strategic acquisitions where loss-making businesses complement an existing portfolio, but for the purposes of this, the profits are key, and the price being paid for the business will reflect this profitability through the earnings multiple being used. Earnings or profit multiples can vary hugely depending on the sector the business is operating in, and landing on the appropriate one for a specific deal is the job of the corporate finance lead advisory team rather than anyone on the FDD side. So to come back to our example, let's say I own a golf course and I've agreed to sell to a bigger group of golf courses for an 8 times multiple of my underlying EBITDA for the last 12 months to September 21, which is why our 9+3 approach is important. In this instance, it's obviously key to arrive at the correct adjusted or underlying position because there's a direct impact on the price being paid. So going back to the example of the travel expenses, if I spot that there's been an upturn in costs in the 9 months to September 21, and management explained that an extra 100 grand of costs was incurred due to a number of round the world trips that some of the senior guys went on to meet other golf courses and discuss marketing strategies, but they've advised that it wasn't very successful. It's going to be scrapped going forward. What this means is it's probably fair for us to remove this 100k of costs from the year-to-date 21 numbers. So the underlying profit is actually higher than what was initially reported. Now, importantly, this works both ways in terms of both removing excessive costs, as we've just talked about, but also adding in missing costs if the business's spending was artificially low in a particular period for whatever reason. The same logic also applies to the business's income. At the moment, it may be appropriate to add in a revenue uplift to counteract the impacts of closures of the golf course due to COVID and lockdowns. Alternatively, if my golf course saw a revenue spike due to hosting a one-off tournament that is not going to return in the future years, it's appropriate to remove the impact of this revenue as best as possible, again, to present the underlying position of the business as accurately as possible in terms of the ongoing profitability. So once all this analysis has been done, the fruit of the P&L focused labour is to present in Excel a table which bridges management's reported trading position to what we deem to be an adjusted trading position, and we're giving explanations for each of the bridging items in the middle. This piece of analysis is obviously supported by qualitative assessments of other key areas such as top customer concentration, how well controlled the operating cost base is, the quality of the incumbent accounting function. Yeah, there's a lot of other areas that we also touch on in the report, but the holy grail, the key for the buyer, is understanding what the adjusted underlying EBITDA looks like for the business. Just to stick with the golf course example, let's say that management initially reported to us that in the 12 months to September 21, EBITDA was £2 million. But through the analysis we've done, we've seen that one-off travel costs were incurred of £100,000. We might have identified that a one-off tournament in the January generated 250,000 of revenue, which we won't see in future years. And we might also say that for the past few years, really we've been a member of staff short in terms of manning the shop. So we're going to add back an extra 25,000 per annum of salary costs to reflect the new hire of somebody immediately after the acquisition. And in total, that gives us 3 adjustments which are going to impact our reported profitability. This is obviously a simplified example. In practice, we probably have closer to 15, 20, 25 adjustments, even more than that, depending on the size of the deal. And these can all impact different financial years in different ways, at different values, depending on the nature of the adjustments themselves. But in this case, the impact of the analysis we've carried out would be to boost reported EBITDA by 100,000 in respect of the travel costs, but netting off that, we'd have a 250,000 removal of one-off revenue, and we're going to put in extra costs of 25,000 in respect of the new person to work in the shop. Once we've aggregated all of these, we can see that the total impact would be a £175,000 reduction in reported revenue, taking us down to 1.825 million on an ongoing adjusted basis. And at this stage, it's really important to come back to the 8 times multiple we referenced earlier to understand the true impact of the work that's been done. The FDD process has identified £175,000 reduction in profits, but in real terms, this leads to a £1.4 million reduction in price for the private equity buyer, from an initial position of 16 million, being 8 times the 2 million that was reported, down to 14.6 based on the new adjusted profit level. So it's a £1.4 million saving. Not bad considering you've spent about 50k on the fees for the FDD team. I think most private equity guys would say that's probably money fairly well spent. So I hope that all made sense to everybody. Obviously there's a real focus there on the adjusted EBITDA position being our primary concern within the P&L analysis. What we've covered there is really how it all works in theory. In practice, there's obviously a lot more nuance and debates between parties as to the true value of certain adjusting items or the relevance of them. But I hope this has given you a little bit of a flavour and hopefully helps prepare for any upcoming interviews. It's also worth noting that we do a similar piece of work on the target business's balance sheet in order to assess the working capital position of the business, which again can have a bearing on the final price paid. I'm about to move on to pulling together a video to talk through all of that side of things, so hopefully that'll be with you shortly. And I'd certainly recommend giving that a watch in conjunction with this one on adjusted earnings to sort of bring both aspects of the process together. In the meantime, any questions or comments, feel free to drop them down below and I will certainly get back to you. Please do give the channel a like, or even better, a subscribe. And I think that's it. All the best till next time. Enjoy Suits.